So, Microsoft is currently sitting at $415.75 today.
Yeah, down nearly 4%.
Right. It's April 23rd, 2026, and I mean, looking at the tape, technical alarms are just flashing red across the board.
Oh, absolutely.
The short-term trend is falling, momentum is totally cracking, and yet, analysts are out there stubbornly calling this a strong buy with massive upside.
It is wild to see.
It really is. So you shared these sources with us to find out what is actually going on here. Like, is this an undervalued opportunity, or are investors stepping into a massive value trap?
Well, it's honestly the ultimate paradox in the market right now.
Yeah.
Because you have institutional desks and then retail traders looking at the exact same charts,
Right.
the exact same
Mhm.
signals, and they're executing completely opposite trades.
It's just crazy. But hey, before we unpack this, make sure to like the video, subscribe to our YouTube channel, and definitely leave your feedback in the comments. We want to hear your take on this.
Yeah, let us know what you think down there.
Because our mission for this deep dive is to just tear down Microsoft's financials, map out the technical order flow, and really debate the bull and bear cases to uncover what is driving this volatility. So, okay, let's unpack this.
We'll do it.
To understand why the stock is dropping today, we can't just look at the 4% drop. We have to look under the hood at the fundamental reality of the company.
Right. Which is fascinating because their fundamental reality kind of defies the law of large numbers right now.
Seriously. I mean, for context, their 52-week low is $356.28, and the high was $555.45. So we're at $415.
Right in the middle of that range.
Yeah. And looking at the trailing 12-month income statement, they have staggering revenue, like roughly $245 billion.
Which represents a 16.67% year-over-year growth rate.
Wait, nearly 17%.
Yeah.
For a company worth trillions.
Exactly. Maintaining that kind of growth at that scale is structurally absurd.
It really is. And the operating income is sitting at about $109 billion. So that's an operating margin of, what, roughly 46%?
Yep, about 46%.
Meaning nearly half of every dollar they make is pure operating profit, leaving them with a net income of around $86.18 billion, or an EPS of $15.98.
Let's hover on that 46% margin for a second.
Okay.
Because that context is so crucial for understanding the market's panic right now. You have to remember, Microsoft is not like some lean software startup with 20 people.
Right, just paying a monthly AWS bill.
Exactly.
Yeah.
They build massive physical things. They lay fiber cables, they build servers, they construct data centers the size of small towns.
Right.
So to maintain a 46% margin while managing that kind of global physical infrastructure,
Yeah.
it just shows how crazy profitable their subscriptions are.
And that profitability has built just a fortress of a balance sheet. I mean, they have roughly $80 billion in highly liquid cash and equivalents.
Just sitting there.
Yeah, against total assets of around $512 billion. And their total debt is super well managed. It's about $106 billion, so the debt-to-equity ratio is safely below 0.40.
Which is incredibly healthy.
So if you just look at that, it's flawless. Why is the stock under so much pressure?
Well, to find the friction, you have to slide over to the cash flow statement. That's where the real story is.
Okay. The gap between the cash they make and the cash they keep.
Precisely.
So their operating cash flow, like the actual cash from selling software and services, is an immense $110 billion.
Right.
But the free cash flow sits drastically lower. It's only at roughly $70 billion.
So that is a $40 billion delta.
Wow.
Yeah. Operating cash is what they generate, but free cash is what's left over after they pay for their capital expenditures.
Right, the physical maintenance and expansion.
Exactly. And that free cash flow number is being actively suppressed right now by just massive, historically aggressive spending on AI infrastructure.
Oh, I see. So it's like owning the most profitable casino in town, but you're taking a huge chunk of your nightly profits and immediately pouring it into building an even bigger casino next door.
That is a perfect analogy.
I mean, is this spending making investors nervous? Because $40 billion is a lot of money to bury in the desert.
It is making them very nervous. And that nervousness is exactly what is manifesting on the stock charts today.
Okay, let's pivot to that. Let's talk technical analysis and the latest news. Because the trend is clearly short-term bearish.
Undeniably.
Yeah.
I mean, it's trading below both its 5-day and 50-day moving averages right now.
Yeah, and looking at the momentum indicators, the 14-day RSI is at 41.51, so it's approaching oversold territory, which usually hints at a potential bounce,
Yeah,
right?
usually, yeah.
But then the MACD is at negative 1.130, so that's a definitive bearish crossover. It's showing continued weakness.
The technicals are fighting each other a bit, but the fundamental fear is overriding it.
Hmm.
We know exactly what news triggered this algorithmic selling pressure today.
Right, the Australia news.
Exactly. Institutional desks are applying massive sell-side pressure, specifically because Microsoft announced an $18 billion AI investment in Australia.
18 billion just in Australia.
Just in Australia.
Wow. So the institutions see that 18 billion leaving the balance sheet, they map out the margin compression, and they just hit the sell button.
They absolutely dump it. But what's fascinating is who is on the other side of that trade.
Oh.
While the smart money is selling the news, retail volume is stubbornly stepping in. Everyday traders are placing buy-the-dip orders right around the $410 level.
Wait, so are everyday retail traders just blindly trying to catch a falling knife here while the institutions are cashing out?
In many cases, yes,
Ah.
because retail sees the price drop from the $555 high and they think, oh, it's on sale.
Right, a discount.
But if that institutional selling pushes the stock below the immediate resistance, which is the 50-day moving average at $419.98, then it's going to test the support floors. And the primary support is the big psychological $400 level.
Oh, retail loves round numbers.
They do. They anchor to it. But if it breaks 400, the next major secondary support isn't until the 200-day moving average.
Which is way down at $388.28.
Exactly. And that dynamic is the exact definition of a value trap.
Okay, let's talk about this value trap debate. Because if retail is buying the dip, do the analysts agree with them?
Well, the analyst data is almost surreal right now. Out of 59 analysts covering Microsoft, 54 say strong buy or buy.
Wow.
5 say hold. And 0, literally 0, have a sell rating on the stock.
You're kidding. 0 sell ratings.
Not a single one. And their consensus price target is $574.53.
So that implies a massive upside, like roughly 38% from where we are today at 415.
Yeah.
So what does this all mean? I mean, I have to play devil's advocate here. 0 sell ratings out of 59 analysts almost feels, I don't know, too optimistic. Like, is Wall Street just ignoring the downside risks?
It's a really fair question.
Yeah.
But you have to remember, analysts are modeling out 12 to 18 months. The algorithmic desks dumping the stock today are just treating the short-term margin compression.
Ah, okay. Different timelines.
Right. And if you look at valuation, Chartmill points out that Microsoft is trading at a PE of 26.05.
Okay, 26. That's not cheap, but it's not insane.
Exactly. And Chartmill suggests it's actually fairly valued when you factor in their projected earnings growth of 18%.
Right, because that multiple shrinks over time. But what about the insider selling? Because I saw net selling over the last quarter from Microsoft executives. That definitely spooks retail traders.
It does. The optics are terrible. But these are mostly scheduled Rule 10b5-1 sales.
Right, the routine executive stock sales for tax purposes or whatever.
Yeah, they schedule them months in advance. But retail traders just see the headline, executives sell as stock drops, and they panic.
Which leads right into that value trap we talked about. They buy at 410, panic at 390-something, and sell right at the bottom at 388.
Exactly. So to figure out if it really is a trap, we have to strip away the chart noise. We need to debate the actual bull and bear fundamental cases.
Okay, I'll take the bull case. So this is the best case recovery scenario. It all comes down to Azure cloud revenue, which is just exploding at roughly 30%.
Thanks entirely to AI integration.
Right, and Copilot is seeing this rapid, super high-margin rollout to massive enterprise clients. Plus, you've got their aggressive share buybacks and a 0.88% dividend yield.
Which provides a really nice safety net for the stock.
Exactly. So that's the bull case. What is the bear case? The worst case continuation lower.
The bear case is all about the Capex concerns. We talked about it earlier. Massive spending on chips and data centers is suppressing short-term margins.
Right, burying the money in the desert.
Yeah. But you also add in regulatory antitrust scrutiny in the EU and the US regarding their cloud and gaming dominance.
Oh, regulators love going after Microsoft.
They
Yeah.
do. And then there's the mounting generative AI competition from Google and, more importantly, Amazon to AWS.
So it's a margin squeeze from all sides.
Exactly. What's fascinating here is that both the bull and the bear cases hinge on the exact same thing.
AI.
Yes, AI. It's either their greatest structural growth engine ever, or it's a massive historic capital sinkhole.
Man, here's where it gets really interesting. It's kind of like Microsoft is the company selling the picks and shovels during a gold rush.
I like that.
But the question is, are they spending too much money manufacturing millions of shovels before the actual miners even show up?
That is the exact anxiety Wall Street is feeling right now.
So let's bring it all home to a concrete timeline. What is the outlook, short term versus long term?
Short term, so the next few weeks, expect extreme volatility. The entire market is basically holding its breath for the upcoming April 29 earnings call.
Oh, April 29th. Everyone is going to be watching that.
They are. But long term, they honestly remain perfectly positioned as the primary AI infrastructure provider.
So what's the pro tip for the listener? What should they actually be listening for on that earnings call?
Don't just look at the headline revenue. You need to watch a specific metric: commercial remaining performance obligations, or RPO.
Okay, RPO. What is that?
It's the total value of contracts that customers have already signed but haven't been delivered or billed yet.
Ah, guaranteed future cash.
Yes, if that RPO number prints above $315 billion,
315 billion. Okay.
then it is a massive bullish signal for future revenue.
Awesome. Well, as we wrap up, we have to give our mandatory disclaimer. This deep dive is just a natural debate of the available data. It is absolutely not financial advice.
No, please do your own research.
Exactly. But I want to leave you with a final lingering question to ponder.
Let's hear it.
If Microsoft's AI monetization fails to scale as fast as their massive capital expenditures, I mean, how long will Wall Street wait before pulling the plug and derating the valuation entirely? Think about that.
That's the trillion-dollar question. Catch you all next time.